Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy. Plus, global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
It is the fifth FOMC decision of the year, that's for sure. And it was an interesting one. Got to say, first of all, Fed officials, as expected, leaving interest rates unchanged, downgrading their view of the U.S. economy. It's a sign policymakers could be edging closer to lowering borrowing costs. But got to say, we moved around a bit in terms of expectations. Governors Christopher Waller and Michelle Bowman voted against the decision in favor of a quarter-point cut. You kept pointing this out to me.
Yeah, it's the first double dissent going back to 1993 for the Fed. So, is that right?
In 30 years.
Yeah, 1993.
Yeah.
So it's pretty wild. So one thing that I noticed about what Jay Powell said, we're going to get to some of his comments in a second, but I just want to, he was asked like what their conversations were about the dissents. He was like, I'm going to let them speak about it in the coming days. So you will hear from them. So stay tuned.
Blackout period stops on Friday.
Yeah,
so we're going to hear
exactly.
stuff. Hey, what we should point out, man, it was quite an interesting meeting. At today's press conference with reporters, Fed Chair Jay Powell covered a lot of ground. And what he said was one of the better meetings of the U.S. Central Bank.
Inflation has been running somewhat above our 2% longer run objective. Recent indicators suggest that growth of economic activity has moderated. The moderation in growth largely reflects a slowdown in consumer spending. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. Basically, this was quite a good meeting all around the table. We have made no decisions about September. We don't do that in advance.
As you just heard, a lot from the Fed chair today, certainly in his statement as well as the Q&A with reporters. So it's made for an interesting trade because we definitely have stocks off of our highs of the session. We've seen rates bounce around as well. I think initially moving a little bit lower and then bouncing back up. So there's a lot for investors and traders to take in from this Fed meeting, Tim.
Yeah, there really is. Let's bring in Karen Veripera, Managing Director and Head of iShares U.S. Fixed Income Strategy at BlackRock. She joins us from San Francisco. It is the world's largest asset manager, had $12.53 trillion in assets under management at the end of the second quarter. Karen joins us once again from San Francisco. Karen, did the Fed get this right?
I think so. So we were just also watching the press conference here on our trading desk, and I think that their main message was we're keeping rates on hold because inflation is still above target, and that would speak to really keeping it a little bit more restrictive. So I think this is actually a good thing in the long run for investors because they're still getting higher levels of interest rates. They're able to reinvest and keep the fixed income asset allocation on track. And so I think for a lot of investors watching the Fed, one of the things that they should take note of is really if these inflation prints are going to continue to come in a little hotter than they expect, maybe you should consider adding some inflation-linked bonds to portfolios. So we're seeing that being a big trend, people really refocusing on adding inflation protection back in.
I love that you went right there. I mean, anybody who's a bond investor, at this point, has to, coming off of this press conference, with all the pressure that the Fed chair has gotten from the President of the United States, have to think that, okay, this guy is going to do his job no matter what.
Yeah, I think that's right. I think we're just so focused here on the long-term trends and meeting to meeting. We're going to see, I'd say, a lot of price action in the bond markets. But I think it's really important to think long-term. And whenever we're looking to the next meeting, as you highlighted, September 17th, there's still a chance that they're gonna cut at that meeting, but they've still got two more on the calendar. And if we just take a look at the dot plot from June, we saw a couple of governors, two governors favored 3 cuts, and I think we now know who they are. But then the other 8 favored about 2 cuts, and that's still what the bond market is pricing in. So I think anybody looking at the short-term focus, they can probably still use that as a barometer. So
you say there's a chance that they'll cut at the September meeting. You don't think that's a done deal at this point?
It's hard to say. I think especially Chairman Powell's comments during the press conference were really telling, is that they don't want to get ahead of themselves. We actually got core PCE coming out tomorrow, and that's also been trending about 2.7%. So I think that's an important number to watch. And we're seeing a lot of investors are slowly starting to move back into fixed income assets, even with some of the uncertainty here. There's still about $7 trillion sitting in money market funds, earning those overnight rates. And then we're slowly seeing people allocate back into more core fixed income exposures, even international bonds, rather than just sit in cash. And they're trying to get ahead of the Fed meeting. And that's what we're seeing money move towards.
You know, what's interesting, too, Diane Swank in our Fed coverage earlier today, noting that we had an inflation print today, reminding us where we saw inflation in both goods and services. I am curious to throw on top of that tax cuts, targeted spending by the legislation that just passed in Congress, expectations on more deregulation, and AI making companies, workers, if you will, more productive. That sounds to me like it's stimulative policies.
I think that's really the trick, is finding the balance between some of the good data that we are getting and some of the productivity gains. We've seen positive wage growth. I think there's been, even though the GDP print came out higher than expected, there was a lot of noise in that just with imports and exports. But I do think the economy is pretty strong, and the Fed's just trying to get back to that neutral rate, and figuring out the timing of that is really the tough part. So I think for a lot of investors, we should... Yeah.
No, I get it. There's a lot. So is it smarter, in your view, and it sounds like this is where Jay Powell is leaning, to make sure that inflation they really do have under control? You don't want to make the mistake of cutting and then having to kind of backtrack and re-raise rates because of inflation ticking higher.
That's right. I think their wait-and-see approach is going to be the playbook for the rest of the year.
So no more rate cuts?
No, I think they're just going to wait and see what the data is telling them. So I think personally we'll still get one or two cuts probably in the back half of the year. So that really speaks to those October, December meetings. But then the Fed did not want to take September off the table either. So I think they left a lot of optionality open during this meeting.
What would make you change your mind about September over the next month? And say essentially that September will definitely see a rate cut?
I think a couple of factors. If we see some of those inflation prints coming in lower than expected in a meaningful way, I think if the trade deals solidify and we get some tariff rates that are not expected to be passed through with inflation, because that's still the big uncertainty out there.
And just to make sure I have this clear from you, are you certain that the next move by the Fed will be a cut and not necessarily an increase?
I don't think it'll be an increase. I think that's not really what's being priced into bond markets. And I think a lot of the discussion around the cuts is really just trying to move it back towards that neutral rate and not becoming more restrictive.
The reason,
right now.
Yeah, sorry to cut you off. We only have about a minute left. The reason I'm interested in that is because we haven't necessarily seen the effect or the impact of tariffs make their way into the inflation numbers. And what economists tell us is just wait, it'll happen, but it hasn't happened. So if that does happen, does that change the trajectory of the Fed?
I think if anything, it just keeps them on hold for even longer, because I think they're going to be reluctant to have done a few cuts already and then make it hike. So I think it'll really just come down to the data and how quickly they can model that. And I think that was something that was highlighted at the press conference today.
Hey, just to wrap up, because we talked a little bit about, I think, where you were finding either opportunities or suggestions to investors. But going back to a Fed and a Fed chair that understands his mandate, understands what the Fed chair's job is, understands what the FOMC's job is in the Federal Reserve in terms of monetary policy and what global investors expect. Having said that, you feel pretty confident maybe going longer out in terms of buying into the U.S. Treasury market? And just quickly, about 30 seconds.
Yeah, I think rates remaining higher are good for investors. I think stepping out of cash, if cash rates are projected to come down, locking in some of those bond yields are really good for investors. I think getting your duration back towards, call it the 3 to 7 year part of the curve is probably prudent for a lot of investors right now who are overweight cash.
Great stuff. Karen, thank you so much. Busy, we know, for you as well as for us, but really appreciate you carving out some time for us. Karen Veriperi, she is head of U.S. iShares fixed income strategy over at the massively BlackRock. I mean, what are we talking about?
The massively massive BlackRock.
$12.53 trillion in assets under management. That was at the end of the second quarter.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app, or watch us live on YouTube.
All right, everybody, we've got Meta Platforms, Microsoft, both out with earnings. Those are the big ones. There's a lot that are out there. But we want to get to it. We've got great team coverage here at Bloomberg and also some great outside voices. So let's get to it with Dan Ives. He's Managing Director and Senior Equity Analyst and Global Head of Technology Research at Wedbush Securities. We're going to start with Meta. Let's talk about it. The stock's up about 8.5% here in the aftermarket. What do you like and what don't you like? Do you not like anything?
There's nothing not to like. I mean, like, look, it speaks to you go through this AI revolution. It's in this next stage of growth. And all the money that you're seeing these big tech players, CapEx, now you're ultimately starting to see some of those dividends get paid. And then you think about the advertising growth, similar to what we saw with Alphabet, what you see with Meta, subscriber growth. I mean, it's Goldilocks, for tech.
How does Meta harness AI to make money apart from making its advertising more efficient?
It's about the billions of users. It's about going forward, how they're going to monetize AI. They're not just spending to spend. They're going to be able to monetize from an advertising perspective when you think about the billions of users they have.
How do they do that, though, Dan?
And the reason Zuckerberg right now is what I view as like a wartime CEO. It's the view that when you think about AI today, this is just the beginning. You're gonna have AI-driven search. You're gonna have sort of the future that Meta, Alphabet are gonna play huge pieces in the advertising piece.
But I want to go, so it's just advertising that's where they're going to make all their money back. We know that they have been on such an aggressive AI talent grab, and Meta has. So
hundreds of millions of dollars.
Yeah, like pay
individuals.
Yeah, so that's all going to pay off. Their return on investment.
That's just the beginning.
Okay.
Advertising just the beginning. When you think about what I view as sort of like full AGI. And it was like the holy grail, what Meta is trying to build, what every big tech player is trying to build. Meta is basically looking to create a whole nother company over the next decade. That's what they're spending on.
This is what I'm still waiting for, Meta platforms. Look, no question this was an incredible quarter. The stock is up 9.3% in the after hours. Just to repeat the numbers, second quarter earnings per share, a huge beat, $7.14. The estimate was for $5.89. Second quarter revenue, a huge beat, $47.5 billion. The estimate was for $44.8 billion. Third quarter revenue, $47.5 to $50.5 billion. That's the outlook. The estimate was for below that at $46.2 billion. But I want to look with you years out when the hardware that they're working on, that they're spending billions of dollars on, will start paying dividends. What does that future look like for Meta users and for Meta investors?
You have to think about it like, what's the future in terms of robotics, in terms of software, in terms of how AI is going to play a role in the everyday of a consumer? I mean, Meta's thinking not in the next year, 3, 5, 8, 10 years out.
I want to bring in Mandeep Singh, if I may, of our Bloomberg Intelligence team. I don't know if it's too soon. I know you're going through all the numbers because I want to bring you into the conversation with Dan. Good quarter, killer quarter. How do you see it for Meta?
Yeah, I mean, there is a sequential acceleration in ad impressions as well as ad pricing growth. And to my mind, that is a sign of them applying AI to boost engagement. Obviously, the user growth has been almost the same every quarter, 4 to 5%. So the fact that impressions grew 11% is a sign that people are spending more time on their family of apps. And then the ad pricing going up 9%. That to me is the real tailwind, because that was the risky part. Chinese advertisers like Temu and Shein pulling back because of the de minimis rule changes. That didn't happen. That didn't show up in the numbers. And look, when it comes to applying AI, I mean, small advertisers are now connecting Meta to their CRM systems, and actually that is what's driving the ad targeting and efficiency. That wasn't the case before. That has been enabled by Gen AI. So that's why you see that lift.
So you agree with Dan?
I think Gen AI use case is quite prominent. We keep hearing about coding agents, customer service. Here is the precise use case for Meta.
Yeah.
And that is what they are showing in their ad pricing numbers.
Dan, come on in. I saw you're saying something.
That sounds like a bullish Mandeep. I mean, for like that's like on the Mandeep scale. That's pretty bullish.
I like that. Hey, Dan, I noticed something striking today when I opened up Instagram. I was searching for a video from Mike Birbiglia, a comedian who I really like. And what I noticed when I was just looking for his profile, when I typed in his name, what appeared was as an AI answer about a biography of who he was, information about him. Is the goal? What is the vision for Instagram? Is this going to be Meta's super app?
To some extent, they're basically creating a super app. I mean, similar to what you see in China, but an AI-driven super app. That's and you start to go through that, you're looking at a 4-digit stock.
They tried to do this years ago with David Marcus on the Messenger side, Mandeep. It didn't necessarily work. It was supposed to be payments and everything. Is that still, in your view, an area of growth for the company here, or is that strategy gone?
I mean, right now it feels like they have a lot of runway with ads, and there is a clear use case for Gen AI with ads. I mean, they still have to fix the model. So I think the advantage that they have is really they are the best when it comes to ad targeting. And with everything that's going on, I mean, they have the surface area to apply Gen AI. But look, when it comes to payments and other areas, they still lack the diversification of a Microsoft or a Google. Well, it's still a one-trick, albeit a $200 billion company, but still dependent on ads.
Dan, it's funny because I was thinking about that because we talk about all of these companies, and I think about the hyperscalers like an Alphabet. We've talked about that a lot, Mandeep, about just all of their different platforms and how much data that gives them to make their models smarter and smarter. I mean, Dan, is it going to be okay for Meta to be kind of a one-trick pony, even if it's a massive one-trick pony, but is it enough?
Well, I mean, look, I think if you think about it on a pecking scale, of course, like NVIDIA at the top, Microsoft, and you look at these numbers, just unbelievable in terms of across the board. You look at Meta, you call it one-trick pony-ish, but but they're going to significantly expand that over the coming years.
No, I mean, at least for now, there is no proof. I feel they are under-earning by 20% because of all the losses in Reality Labs, but the street doesn't care because their ad business is really going gangbusters. When the ads slow down and the comps will get tougher and there will be a point when ads will not grow 20%, that's when I think the question will be asked, why are they losing $20 billion on Reality Labs? Because it's not making any money.
When will it start making money, Dan?
And does it matter?
I mean, look, it's going to be a while, but like the whole point is right now that's background noise. Like, in other words, like Street wants them to continue to invest, build this further out. And at the end of the day, that is going to come into the fold. But you're not right now in this arms race in big tech. You are laser focused on who's going to be the winner. And that's what we're seeing from Microsoft to Alphabet to Meta, obviously, across the board, and we'll see it with Amazon as well. Like, it's an arms race.
I mean, the one other data point I would want to bring in is token count. So Google and Microsoft have shared the Gen AI consumption, the token count. We don't know how much Meta's models are being used. Yes, their ad targeting is great, which is why ad pricing was such a solid number this quarter. But at the end of the day, if you're investing $70 billion in CapEx, you want to see your model being used and the open source strategy work. We have no proof points of that. So I still believe they have the most uphill task in terms of showing ROI on the the CapEx besides their family of apps, and that's still the case.
Dan, I know you got to go, but 30 seconds, last question for you. What's the one question you'd ask Mark Zuckerberg tonight?
Look, I think it's really about CapEx trajectory, because I think that's just, even though that was slow a bit, they're putting, as they continue to spend, you know what that shows? Confidence. And that's what you saw in Alphabet. That's what you see in Microsoft. And that means it continues to be like, this is the AI revolution, this AI party. It's 10 p.m., it was 9 p.m. Party goes to 4 a.m.
Hey, listen, before you go, I know we said last question, but not that we lie, but you're here and you're Dan Ives. Microsoft, you said that was also a big killer report. I mean, the stock was just crazy in the aftermarket. It's up about 6.8%.
Scotty Scheffler-like results, right? I mean, the point is like massive beat on cloud. You see more and more of these use cases, these hyperscalers, those are the best indicators. That just shows where the next spending in AI is going. And that's why right now, if you're a tech bear, you're in hibernation mode in that cave and you can't find AI in the spreadsheet.
Pretty crazy. Pretty interesting. Hey, listen, we know you're busy. We know you're bouncing around and got stuff to do, but always good to get some time with you. Dan Ives, Managing Director and Senior Equity Analyst over at Wedbush Securities, also Global Head of Technology Research. What would be your number question, though, Mandeep, to ask on the call? Because I think it's interesting what you said about the information we get from Alphabet. Do they never answer those questions in terms of?
You have to compare the tokenization. The reason why Alphabet and Microsoft are more upfront is because they have a cloud business where they are monetizing the consumption, and that's what's driving the cloud revenue and the AI portion of that.
Right.
In the case of Alphabet, they don't have a cloud business.
Meta.
Sorry, Meta.
Yeah.
And so in their case, it's all internal usage. They don't rent their GPUs or the AI infrastructure to anyone else. And if you are using internally, then, I mean, the ecosystem doesn't know what kind of usage is there for a Llama model.
Like what it's costing, right, to juice what they're doing?
We know what it's costing because they are spending, $70 billion in CapEx.
Right.
But in terms of what is the utilization, because this kind of infrastructure depreciates very fast.
Right.
You're going to write it off in the next 3 years. So granted, you're using it internally and it's showing up in the numbers this quarter. But if you are spending this every year, then you want to show very high utilization, especially because you're open sourcing your model. And if your model is not getting adopted, then the open source strategy isn't working.
I just want to remind everybody where we've come in the last few years with Meta Platforms. There was a lot of talk in late 2022 of leaving this company for dead when they made their pivot to the metaverse. Shares were trading at $88. Now it's
back to the IPO.
Oh,
sorry.
Yeah, I mean even a recent history.
Right.
It's up 686% since then. That doesn't include the surge in the after hours, which, if it holds, will be a new record for Meta Platforms tomorrow.
Yeah, and look, when people were, selling the stock at $80, then they didn't really factor in, Meta's engagement. So what's really brought them back in such a big way is people are still spending over an hour and a half across their family of apps. So that sort of engage, and look, that's where the real risk comes in. So ChatGPT now is about 30 minutes across its daily active users, which is much smaller than Meta. Meta has over 3 billion, and ChatGPT is still, less than 400 or 500 million. So still much small, but they are taking share in terms of engagement time. People are spending 30 minutes on ChatGPT. So as long as Meta keeps growing engagement, I think they will keep growing earnings, and that's what they're showing with their ad revenue.
All hails Mandeep. Mandeep Singh, of course, with our Bloomberg Intelligence team. He is Bloomberg Intelligence Global Head of Technology Research. Be sure to check out his research on the Bloomberg when it comes to Meta. So appreciate it.
You're listening to the Bloomberg Businessweek Daily Podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
And then we've also got Microsoft. That stock is up about 7.9% here in the aftermarket. And that one, some really, really strong numbers as well. Quarterly cloud sales profit exceeding expectations. They say they brought in more than $75 billion in the past year in terms of its cloud business as the company continues to commercialize AI services, Tim.
We got a great group of folks, a great duo to talk Microsoft and more. I want to bring in Greg Halter, Director of Research at the Registered Investment Advisor, Carnegie Investment Council. They've got about $6.5 billion in assets under management. Also want to bring in Bloomberg Intelligence Senior Tech Analyst Anurag Rana. He joins us from our Chicago bureau. Greg, just for some context, Microsoft is the largest holding. Is it a largest individual holding for your group, or is it because it's in index funds? I just want to set the stage before we get into the details.
Thank you, Tim, and thanks for having me. We do not count the index fund holding positions in that number. If you look at our latest 13F filing, Microsoft is the largest individual stock holding at Carnegie.
All right, so Microsoft, investors certainly like it in the aftermarket. As we mentioned, Greg, the stock is definitely soaring up about 8% now as I speak. What jumps out at you?
I think the Azure growth, 39% versus the 34% expected, that is huge. I'll also point out that their EPS beat of 8% plus is the best in 7 quarters. Usually they do beat. I think it's been now only 4 times over the last 45 periods they have missed on earnings. And this is a larger point of exceeding the estimate that they've had in 7 periods.
All right, I want to
like
bring
it.
You like it. All right. Anurag Rana, I want to bring you in here. I'm not sure. I think we all went into this week with a little trepidation over everything that was coming at investors, including some of these big tech earnings. But this, certainly investors like what they got from the company, and certainly with the outlook. What's your take here? What's important for investors to learn off of this release?
I would echo what our other guests said. I mean, the acceleration in Azure is pretty impressive. And one of the things I think it's going to do, it's going to tell people that all the CapEx Microsoft is spending, they're getting the benefit of it on the other side of it. And they're probably the first one to recognize a bigger, load of AI revenue coming in. And, this will pacify a lot of people out there that may be worried that why are these companies spending so much on AI infrastructure, and where is the, other side of the equation. So I think it's a good result, not just for Microsoft, but the entire tech platform.
Well, and that's what I want to just follow, Anurag. Our preview of all of this was Microsoft Meta investors are going to be scrutinizing over the AI spending binge. So for Microsoft, clearly to you, we are clearly seeing the ROI when it comes to that AI spend.
Yeah, both on the top side, and they are doing extremely well on the expense management side, because what happens is when you're seeing a rapid growth in Azure, which has a relatively lower gross margin than the rest of the Microsoft business, profitability does get dented with, in addition to all the AI investments that they're making. What they did this time was, year over year, they kept their headcount flat. I mean, that's a huge boost to, you could say, profitability as well as productivity. And, I think that's something for people to take home also.
Hey, Greg, I want to bring you back in here. Looking at the Azure growth here, the company reported better than expected growth in its cloud business. The Microsoft saying it brought in more than $75 billion in the past year. The company continues to commercialize AI services. Give us your bull case on AI and Microsoft, because essentially this company is deploying AI tools and it's betting that these conversant chatbots and more powerful automation tools are going to boost sales of Microsoft's productivity software and cloud services. Is that bet paying off right now?
I don't know that you can say it's 100% paying off. The reaction to the stock indicates that investors believe that it will. This stock was coming into the report at 34 times earnings, so a lot has to go right, and it appears that a lot is going right. So yes, we've done a look at their CapEx and R&D over the last 10, 12 years or so. It's not like this is new. It's just that the numbers are big. I mean, the percentages are also fairly large, but they're spending billions and billions on R&D. Of course, now they can get the tax benefits from that. Billions of dollars, not just Microsoft, but others. And you would hope that they're wisely investing in that R&D for future profitable products and services.
Hey, I do want to point out, too, that we see Amazon shares up about 2.7% here in the aftermarket. Shares of Alphabet are down about 0.4%. But, of course, Amazon reporting along with Apple tomorrow. Anurag, I don't know. Is there any cause for concerns or things that you want to question or would question with the C-suite following Microsoft's release here?
I think I would talk about the headcount growth for next year. What are they baking? Because it's been almost 2 years where they have added very little headcount to the overall, company size. And the big question over there is this something that we should anticipate going forward? That you're getting all this cloud revenue, but you're not adding a lot more headcount. Because I think that's slightly concerning. Not so much for Microsoft, but the rest of the tech industry, because somebody that is selling HR software or sales software depends on companies hiring quite a bit because it's a seat-based model. And I think that's an area, but that's not so much, I would say, Microsoft's problem, but that the rest of the tech industry's issue.
All right, going to leave it there. Folks, thank you so much. Anurag Rana, Senior Tech Analyst with Bloomberg Intelligence out there in Chicago. And Greg Halter, our thanks to you as well, Director of Research at the Registered Investment Advisor, Carnegie Investment, with the latest on Microsoft and Meta.
This is the Bloomberg Businessweek Daily Podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.